Welcome to RenMac Off Script. We open to discuss markets, economics, policy, history, and life. It's the 19th of April, 2024. I'm Jeff DeGraff, and I'm solo today. The rest of the crew is on spring break, as I am, looking at universities for my youngest son, but wanted to get into it a little bit on these markets, particularly since we've had roughly a 5% drawdown from the most recent peak. So very quickly, we'll make this a short one today, but there are essentially three pillars of a viable oversold condition in an uptrend. And the way that we think about those are internal oversold conditions. Those are things like the percentage of names that are oversold in our oscillator. Those are things like the percentage of names making 20-day lows. That number did eclipse 50% earlier this week. That's a good reading. That does suggest that it's been indiscriminate selling, and that's one of the things that we look for, that their risk is being taken down wholesale. So we like to see that. On the oversold condition externally, that is what's happening to the indices themselves. Believe it or not, we're not quite oversold yet on the S&P. We're not oversold yet on the NDX. We're using the RenMac oscillator here. We are oversold on the Russell 2000. We are oversold on the Russell 3000. And we are oversold on the S&P on an equal weighted basis. So we are getting some of those features, but not in totality. That's what we like to see, is really the combination of all these things giving us a good, solid oversold reading. So not yet there on the external oversold condition, certainly getting some indications from the internal oversold conditions that were set up relatively well for some type of bounce. The final is a sentiment shift. We want to see that the market participants are starting to shift away from the optimism, the good time. If you remember, we warned clients about the buyer's frenzy, particularly in semiconductors, back at the end of February, early March, that it was likely unsustainable, that the expectations were just too high, along with the momentum. And we have started to see that obviously peel itself back a little bit here with this most recent decline. Now, I wouldn't say that sentiment has shifted enough, and we don't need sentiment to reach some bearish extreme where people are looking for more downside than upside. We just need to soften the expectations. And the first indication that we've seen here is the put-call ratio has started to swell. It recently got above 1. We like to see that on a 10-day basis to give us the confidence that people really have started to play for the downside versus the upside. I wouldn't expect to see it much in the survey data, the consensus saying, the investors' intelligence. Those tend to be a little bit more slowly or move more slowly in terms of their positioning. So my expectation is that what we'll end up seeing is something within these put calls to start to swell to give us more of an indication that, in fact, the sentiment has changed and shifted itself more towards the downside, or at least protecting the downside versus the upside. So again, the three pillars being the internal oversold condition, which I think it's fair to say that we can check that off. We have seen some of those indications spike for us. Now, it is possible that they create these what we call bullish divergences, where the market will go down further, but these indications will actually not expand or get any worse. So internally, things are actually healing, not deteriorating. So that may in fact happen. But we'd also like to see the external oversold conditions develop. Again, it's going to be more specific to the NDX. It's going to be more specific to the S&P cap weighted. And then finally, see some type of shift in the sentiment where people are more anxious about the downside than they are greedy about the upside. And again, starting to see some evidence of that, but not enough for us to make a rock solid table pounding call. But within that, we still think that this is a correction within an uptrend. And those corrections usually don't end up being anything more than 10% to the downside from a drawdown perspective. So we still think that we're in that camp, despite what we're seeing out of yields, because we're not yet seeing deterioration in credit, etc. But we'll get into that on the Monday morning macro call, where you're going to hear Neil, you'll hear Steve, and you'll hear Howard. All will have their thoughts about this week and the upcoming week. Thanks for joining us. Again, we'll be back next week, 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn for important updates. And if you want some deeper insight, go to renmac.com, where you'll also see our disclosures and disclaimers at that site as well. Until then, I'm Jeffy Graff. We'll see you.